Hello and welcome everyone. This is Pursuing Income with Credit Spreads. This is Sean Howell, Senior Strategist with Investor Education at E-Trade, and I'll be your instructor for this video. Thanks for joining. Before we get started, just a couple of real quick disclosures I'd like to review. So one of the things that I try to do in all the presentations is I try to include some real-world examples. Just know that those examples have really been selected because they tend to illustrate the points that I'm trying to get across very clearly. None of these are recommendations, of course. This is strictly for educational purposes. Let's get rolling here. So the goal of this is for you to learn the strategy, execution, and management of vertical credit spreads. Now, when I'm teaching debit spreads, people are usually bringing up the fact that, why are you teaching debit spreads instead of credit spreads? I personally prefer credit spreads over debit spreads. But the reason that I'll typically teach debit spreads before credit spreads, even though they're almost exactly the same, is that it tends to be easier for people to understand debit spreads over credit spreads. So I'll go through this presentation very slow and intentional so that hopefully you'll pick up everything here and you'll understand the differences between the two. But again, they're almost mirrored strategies with just a couple of advantages I feel in credit spreads over debit spreads. And I'll point those out as I go through the presentation as well. So here's the agenda that we're going to cover. I'll go through and explain vertical credit spreads, and then I'll go through and explain what a put spread is, the bull put, and then we'll move over and talk about the bear call. That's where I'll bring in a live example as well. So what's a vertical credit spread? Let's talk a little bit about the key points here. Well, first of all, it's a multi-leg option strategy. This means that you're both a buyer in which you have the right to do something, so you're buying a call or buying a put, but you are also taking on the obligatory side as well. So you're going to have both rights and obligations in this case. In fact, the way that this sets up as a credit spread is that your obligation is going to bring in more money than the amount of money that you're going to spend on the right. So therefore, there is a credit that's left behind. So let's go to the second bullet point here. It involves the selling and buying of an options contract. So of course, when you're selling, you're going to take on the obligation. And when you're buying, you're going to be taking on a right, or I should say you're going to be purchasing a right. And you're buying options that have the same month but different strike prices. Now there's two types. There's going to be a bull put. Now the bull put means that I'm bullish on the underlying. It could be a stock, it could be an ETF, or it can be an index. So I'm bullish and I'm going to be utilizing puts. Now sometimes that throws people off a little bit. If you're bullish, why are you using puts? I would have assumed that if you were bullish, you'd be using calls. And that would be correct if we were doing a debit spread in which we would be buying one call and selling another call. But instead, we're going to utilize puts because we're going to bring in the credit. We will sell the put that we believe is going to not be in the money at expiration. And we will buy a put simply in case we are wrong. So we believe it's going to go higher. And sort of the opposite is the case for the bear call. I'm bearish on a stock, so I'm going to sell a call option that is generally in the money in the belief that at expiration, that call option is no longer going to be in the money. It is going to be out the money, and I'm going to be able to keep the credit that I brought in from selling that call. Now, these are spreads. So the reason that we are buying a call or a put is really in case we're wrong. It's sort of our get out plan. If I just sold a call option because I was bearish on a stock, now I could do that, and that is a bear market strategy. But if I just sold the call option, then I would be naked and I would have unlimited risk. With unlimited risk, I couldn't do this kind of strategy in, let's say, a retirement account. So by selling a call option and then buying a call option, essentially I've built in some protection and make it a defined risk trade. So let me go through the next bullet point, which explains a little bit further. It involves selling a higher value option. Now, when I say higher value, don't think higher strike price, just think a higher value option. So for example, think of selling a call or a put for $1. So it involves selling a higher value option, and we're going to call that the short leg. The short leg is your obligation. That's your obligatory leg. And we're going to take some of that money that we have brought in, and we're going to buy a lower value. Again, don't think value and strike prices. Lower value would simply mean it costs less than the money that we brought in. So if I was saying our short leg brought in $1, then I'm going to say that our long leg is going to cost, let's just say 25 cents. So if I brought in $1 and I have to pay out 25 cents, well, there's still a credit in my account of 75 cents, and that's called a net credit. That's the net credit to the account. So we've built our credit spread based on that right there. Let's talk about maximum profit. Well, the most that you can make on the trade is what you just brought in. In my example of you brought in $1, but then paid out 25 cents, so you have a net credit for 75 cents, that is your maximum profit. So you are hoping that you are going to hold on to the maximum profit all the way to expiration. Now, the maximum loss is the width of the spread. So using my example, let's say that the width of the spread, well, I'll say that I had sold the $20 and I had bought the $25. So I've got a $5 wide spread and I brought in 75 cents. Okay, the maximum loss is the width of the spread, $5 minus the credit, and that would happen at expiration. So $5 minus 75 cents means that I've got $4.25 at risk. That's as bad as it could possibly get. I could lose $4.25 at expiration. It couldn't get any worse than that, and it can't get any better than keeping that 75 cents at expiration. Okay, let's keep rolling through here. So with any option strategy, there is no perfect strategy. All the strategies have pros and they have cons, and I like to highlight exactly what those pros and those cons are. So one of the pros is that you can create credit spreads for bull markets, bear markets, and even neutral markets. So they're very, very flexible for all market conditions. In fact, that flexibility goes a little bit further and allows us to adjust them for risk, for reward, and probability. It's sort of a three-way balancing act here. I could have, let's say, low risk and high reward, but the trade-off to have a low-risk, high-reward trade is going to be a very low probability of success. Or I could have a high-risk, low-reward trade, and the trade-off there is going to be having higher probability. So we can go through that too as I get some examples here. Now, another pro is that it generates an account credit when trade executes. You know, it's not really much of a pro, but people just like to see that they're getting paid something. Unlike a debit spread where you pay the money and you hope that at the end you're going to be able to close a position out and capture more, a higher return on your investment. Well, with a credit spread, you get the money up front and you hope that you get to keep it in the end. And as a result of that, you could potentially have fewer trading fees. And the reason that's the case is in an ideal situation, the two legs of the credit spread are going to both expire worthless. If I brought in $75 from a one contract credit spread, and if I had done this correctly, as good as it possibly could be, at expiration, both legs will expire, which means that the $75 in my account stays in my account, and that cash is no longer encumbered by having any obligations whatsoever. So I can go ahead and go and do whatever I want with that money. Okay, let's talk about some downsides here. Well, because we are making these defined risk trades, the trade-off there is we're going to have limited upside potential. So if you set up a credit spread anticipating that something is going to move up some, what if it moves up a whole bunch? Well, the most money you could make, going back to my example, was that $75. So it doesn't get really any better than the credit that you brought in. So sometimes you can do a credit spread and be even more right than you thought and see that you've left some money on the table. So you've defined exactly how much money you can make, but you've also defined exactly how much money you could possibly lose on the trade. They're slightly more complex than debit spreads. That's generally why I first teach people debit spreads. But again, if at the end of this video you feel that you've got it, great. There's really not much more to it than what we're going through here. There's also something that I call no man's land. Now, this is a Sean term. Well, no man's land means that you're kind of in between that making money and losing money point. And I'll walk you through. I've got an example on that. And then also you have some early assignment risk as well. Since you are taking on obligations here, the person on the other end of that transaction may decide that they want to exercise. And so therefore you have some early assignment risk. Now I'm using the word risk here, but as I go through this, I want you to think, what would be the risk of taking an early assignment? In fact, when you're doing a credit spread, you actually want an early assignment. That would be an okay thing to happen, and I'll explain why as I go through it. Okay, let's get into vertical put spreads. Let's start to dive a little bit deeper into the bull put spread. Okay, so in this example here, we're going to build the bull put spread. Now take a look at the chart here, or take a look at the graph. What I've got is I've got a nice uptrending stock. And I'm going to go through the points here. The current price of the stock is $100. We've been uptrending here. I'm going to sell a contract of the 105 strike for $600. So I'm selling the 105 put. And the current price on that is $6. So if I'm selling one contract, I'm bringing in $600. Now think about that. The reason I'm selling a put is that I believe by expiration, the stock that is currently at $100 is going to be higher than 105. If at expiration it is higher than 105, then the $6 per share or $600 per contract that I am bringing in, that option will be essentially worthless. And when it is worthless, it will expire worthless, which means that my obligation is fulfilled because it expired worthless. And the $600 that I brought into my account is mine to keep without any obligation whatsoever. So that's really just selling a put. But if I did that, if I went ahead and I sold that 105, I would need to fully cover the obligation for those 100 shares. I need to have the equivalent of $10,500. So that basically consumes a lot of the equity, or I should say it's rather equity intense to just sell the put. But what we're going to do instead is we're going to take a little bit of that $6 and we're going to buy what if we're wrong plan B. And what we're going to buy simultaneously is we're going to buy the 95 put. By buying the 95 put, that gives me the right to sell shares at $95. So if I'm wrong and the stock does not go higher, it does the opposite and it goes lower, and it really goes lower below 95, then what would happen at expiration is I would be buying shares at 105, and if the stock is below 95, I have a way that I could then guarantee to sell those shares at 95. Now, granted, that's not something I want to have happen, but if you are forced to buy a share at 105, and you liquidate that same share at 95, well, how much money do you lose on that? You lose $10 a share. But remember, we are bringing in a net credit of $500 or $5 per share. So therefore, if this goes perfect, then the stock will be higher than 105 at expiration, and the net credit of $500 for my contract is mine to keep. If it goes perfectly wrong, then at expiration, the shares will be below $95. I will be forced to buy shares at 105, and then I will simultaneously sell those shares at 95. I will lose $10 per share in the process, but remember, it's not $10 of entirely my money. It's $5 of someone else's money, the credit that I got, and $5 of my own money. So that allows us to go through, in the upper right-hand corner, all the P&L scenarios here. The stock price is at $100. My break even is $100. My maximum loss will happen at expiration if the stock is below 95, and I'll lose $500. My maximum gain will happen at expiration if the stock is greater than 105, and I'll make $500. And the time to expiration is 30 days. So I'm bullish. I need the stock to go from its current price of 100 to at least 105. Going higher than 105 doesn't make me any more money, just as I don't want it to go down, and I certainly don't want it to go down below 95, but going below 95 does not necessarily lose me more money. If it's below 95 at expiration, I've lost my $500. There you go. So it's pretty binary about what could happen. All right, let's get moving through here on the scenarios. Scenario 1, this is exactly what you want. The stock rises to 106 at expiration. So here we are 30 days later. The stock is at 106. The option is about to expire. What do you need to do? And here's the answer that we all want to have happen with this kind of trade. You don't need to do anything at all, because if the market's about to close and the options are about to expire, the short leg, the 105 put, is currently out the money, which means that the 95 put is very far out the money, which means both of those will expire, which is exactly what I wanted. And you can see the upper right-hand corner, I'm at maximum gain because we're at expiration and the price of the stock is greater than 105, which means they will both expire, which means the $500 in my account is no longer encumbered by an obligation, and I could do with it whatever I want. By the way, I could do with this money whatever I want over the past 30 days, but it's just nice to know that, hey, it's no longer unencumbered. I've hit my maximum profit point. Now, in hindsight, was there anything that I could have really done better in this example? Well, I was thinking the stock was going to get to 105, but actually it kind of overshot and went to 106. So in hindsight, if I could go back and do this again, if I knew exactly what it was going to do, my short leg would have been the 106 because I would have made more money on it. But again, hindsight's 2020. This trade worked out perfectly. This would be exactly what I hope to see for everyone. Okay, scenario 1. Now remember, options are very liquid. So in scenario 2, we may decide to take advantage of their liquidity and close the position out prior to expiration. So 1 week later, the stock has soared to 108. Now, at first you might see that and think, wow, this is really awesome. But it's maybe not as awesome as you would think because the stock is at 108. Remember, our maximum profit is $500 that will happen at expiration when the stock is greater than 105. So here we are a week later with the stock at 108, which is really good, but we're not at expiration. So if we look at the trade, and that's the second point here, how has this affected the profit and loss? Well, it's definitely helped the profit, but the profit can't be helped any better than a $500 gain. So if I look at this and I run the math and I say, okay, maybe I just want to take my profit and move on to the next trade because there's still 3 weeks left to go. Let's say that you could close this position out and make $400. Would you? That's the question. If you close it out right now, you'll walk away with 80% of your profit in the first week. Would you close it out? Now, my general rule of thumb is yes. And the reason I'm saying that is, let me explain the rule. If I can close out a spread like this and capture 2/3 of the profit, well, I'm talking about capturing 80% of the profit. If I can capture at least 2/3 of the profit in 1/3 of the risk time. So I look at these 30 days as 30 days of being exposed to risk. Well, we're only 1 week into it. So we're 25% in through the risk period, and I can close it out and capture 80%. Now, I would generally close this trade out. That's my general rule of thumb because when something takes a stock from 100 to 108 in a week, something is going on. That could be a buyout that could get reversed. It could be some sort of a hedge fund manager accumulating shares. There's a lot of things that could be happening, and I've been in trades like this where I'm thinking, absolutely, I'm going to stick around for the next 3 weeks to try to make another $100. And those trades have turned on me from time to time, and I learned a painful lesson. So my general rule of thumb, I would close this thing out. I would take my $400 profit, and I'd move on to the next trade. That is, to me, a successful trade. Of course, what are your choices? Close it out, or you could stay in the position, or you could do some other things. You could roll the trade forward, but we're not going to add complexity to the trade. I just want to be sure that you understand, hey, this trade worked out really well. You can close it out, you can capture that profit, and you can move on to another trade, or you can stay in. Okay, scenario 3. Stock is 103 before expiration. Okay, this is what I call no man's land. So the reason I'm calling it no man's land is that your 105 put didn't quite go perfectly, right? Perfectly would be at expiration, it would be higher than 105. But fortunately, it also didn't go horribly wrong. And down below 95. So you're at 103. Now, notice the note in orange. Options that are in the money by at least 1 cent are automatically exercised. So if we are a day or two or the same day that this thing is going to expire, if it closes at 103, that would mean the 105 put is in the money by 2 points. So remember, anything that is in the money by at least a penny, and this thing is in the money by $2, are going to be automatically exercised. So if I don't do anything over the weekend here, I'm going to end up buying 100 shares at 105, and those shares are currently worth 103. So if I end up owning them over the weekend, come Monday morning, I have gap risk exposure. Now, if I'm fine owning the shares and I'm fine having that gap risk exposure, then there's nothing that you need to do. But most people I know don't want that. That's why they're trading options, and they'll close this position out. So let's talk about closing the position out. Since as we approach expiration, the stock is at 103 and it's a 105 strike. Well, intrinsically, this thing is worth $2. But let's just say that in order to buy it back, it's going to cost me $2.10 per share. Well, since it's a one contract position, it's going to cost me $210. So here's what this looks like. You brought in your $500, and now you've decided this thing is working out pretty well. It's not working out as well as I had hoped it would, but it's still working out pretty good because it's going to cost you $210 to buy it back. So of the $500 credit you brought in, you have to pay back $210 to close the position out. Who cares? You still walk with a very healthy profit on that. What am I looking at here? Yeah, a nice profit on that one. So it's not the best situation, but it's still a very good situation. Okay, that's scenario 3 when you're in no man's land. Just remember to be aware of, as we reach expiration, are you in the money? Are you out the money? Where are you at in here? In this case, the position is in the money by $2. The reason you can't buy it back for $2 is no market maker is going to let you close out a position without a little bit of meat left on the bone for him or her. So that's why I'm saying it has an intrinsic value of $2, but you could probably get out of the trade for $2.10. Okay, which would be $210. All right, let's go to scenario 4. Stock drops quickly to $90. So remember on my example where the stock jumped quickly to 108, this is the opposite of that. The stock drops quickly and it's at $90 right now. How has this affected the P&L of the position? Well, remember, the most money that we could lose would be $500, and that would happen at expiration, and we are not at expiration yet. Let's say that we're still a few weeks away from expiration. And that would happen if the stock is below 95. Well, the stock is below 95, but we are not at expiration. Which, let's just use the opposite example of that 1 week where the stock popped to 108. And let's say you look at how much you're down. To close the position out right now, you would lose $400. So you'd have to give back the $500 credit that you brought in initially, and then you'd have to give back another $400 of your hard-earned money. So you were down $400. What do? Do you close it out, or do you decide you're just going to stick around? Do you salvage what's left of the position, or do you hope you get lucky? And over the next couple of weeks, you hope that the stock rallies. Now, again, if you've got a sell discipline when you're profitable, I would encourage you to think about your sell discipline when you're at a losing trade. But at the same time, the reason that you are doing this kind of a spread is because you've already accepted the worst case scenario, and you're 80% of the way to worst case scenario. So if you were to go all the way to expiration, you're already down $400. You go another 2 or 3 weeks and lose another $100, another 25%. So be it. Then that's entirely your call on that one. If this was, let's say, not a spread, if this was just selling a put option, I would say, wow, you still have a ton of downside risk. You probably need to think about getting out now, or at what point would you get out? So I know people really do like the concept of just selling puts, but I've been in this industry a long time, and I'll encourage people, make it a spread order so that you have this plan B. Again, if you brought in 600, you're only paying out 100. And if you're more comfortable with even more risk, so in this case, we bought the 95 put for $1. Well, shoot, you could have bought the 90 put or the 85 put and made it less money if you have a greater risk tolerance. So however wide you make the spread should sort of be aligned to your risk tolerance. Okay, scenario 4, lots to talk about on that one. Well, let's talk about scenario 5. Not a lot to talk about with this one. The stock falls to $90 at expiration. This is as bad as it gets. So 30 days later, the trade is completely blown up in your face. The stock is at $90. It's about to expire. Well, what's going to happen? Well, what's going to happen in your account is that since you sold the 105 and it's in the money at expiration, you're going to buy shares. You're going to buy 100 shares at 105, so that's $10,500. But because the 95 put is also in the money, stock is at 90, 95 put that you have the right to sell, that will also automatically exercise. So you will automatically buy 100 shares at $105 for $10,500, and you will also automatically sell those shares at $95 and bring in $9,500. All right, when you sell shares at $95 that you paid $105 for, you lose $10, right? It was 100 shares, so if you lose $10 per 100 shares, you've lost $1,000. But wait, remember, it's not entirely $1,000 of your hard-earned money. It's $500 from the credit spread you put on 30 days ago, and it's $500 of your hard-earned money. So this was worst case scenario. You lost $500. You didn't have to do anything at all. Oh, and by the way, the cost to execute this, exercise and assignment fees, $0. And also, you do not need to have any additional money. I don't want you to think Sean was talking about buying $10,500 worth of stock in this situation where you are at the worst case scenario where both contracts are in the money. They will auto exercise and auto assign, and we will do what's called a same day substitution. That's broker speak. We'll do a same day substitution, and you'll end up losing $500. End of story. That's as bad as it gets. Now, notice my third point. That's the one I want to concentrate on here. What if you didn't buy the 95 put? If you did not buy the 95 put and you didn't do anything at expiration, then you would be buying $10,500 worth of stock. And the stock, hopefully Monday morning, would open at 90. Now, you could keep the stock if you could afford to hold this position, or you could sell the stock, but you'd be selling it at $90. So in other words, that would be $10,500 worth of buying stock, and you'd be liquidating it for $9,000. So, think about you're losing $1,500 there. Now, I guess the only silver lining around that is that since you didn't buy that put, instead of you having a credit of $500, you would have had a credit of $600 in that case. So you still lose more money with this one. So this is why we define the risk. This is why we utilize a spread order here, because it doesn't matter how much below 95 it goes. We already know how bad it can get. All right, hopefully you're not going to see a lot of scenario 5. Okay, let's talk about vertical call spreads now. Now, if you understand vertical put spreads, the bull put, then you're going to understand the call spreads as well, the bear call. So I'll be able to move through this example at a pretty expeditious rate here. So I went ahead and took a screenshot of Facebook. Facebook was at 197.49, and it had recently gapped down pretty heavily. I'd seen some surges in volume, and I thought, okay, kind of got a bearish looking setup here. This may be a interesting trade to do a bear call. So when I took this screenshot, and by the way, I took it February 25th of 2020. If you want to go back and just take a look at the price action or add other indicators that you like to look at here. It was at 197.49 using a 3-month daily chart. And I thought we had more downside. So I went ahead and was thinking, well, where is this thing likely to find support? Where is it likely to encounter buyers? So I went back to about December 14th, down to that low, which was about $93 or so. So I thought, there doesn't appear to be much historical buying support over the past couple of months here until we get down to about 193. So I was thinking 193 is my target if I was going to do the bear call. And then I thought, well, where is this thing? When do I need to kind of throw in the towel? Well, I was thinking if we can get back above about 202, 203 and get into that gap area there, once that gap begins to fill, frequently they will continue to fill. So I thought, Okay, when do I need to admit defeat on this thing? What is kind of a realistic level in which I see resistance, and if we get through that resistance, then we're going to keep going higher, which is not what I want with a bear call spread. So this is my general trade setup. It's at 197.40. I've got a target of 193.06. And hopefully we're not going to see it get up to about 202.5, but that's how I'd set it up. So let me walk you through the trade here. So here I am on Power E-Trade, and I've set up my call vertical, in which I am selling one contract of the March 6, 192.5. That was right below my target. And I'll be selling that, of course, on the bid somewhere around 795. You'll see there's a pretty big bid-ask spread there. I'll try to get in the middle there. And then at the same time, while I'm selling that, I'm also going to be buying same number of contracts, one of the March 6, 202.5. Again, that's a call option. And then we're dropping down here to the limit. I'm going to go in at the midpoint, which is $5.22, which brings me into $522. That's not inclusive of the fees associated with that, but I'm bringing in $522. Now, how wide is this credit? Or I should say, how wide is this spread? Well, if I was speaking in option terms, I would say, hey, I've got a bear call spread in which I am short the 192.50 and I am long the 202.5 March 6 expiration, and I did that 10-point spread for a $5.22 credit. So right away, that sort of communicates exactly what I've got set up here. Okay, so the most I could make is the 522. In fact, let me go to Snapshot analysis, and on Power E-Trade, it will walk you through sort of your scenarios here. So let's go to Snapshot analysis here. The maximum profit is going to be $522. And remember, that will happen at expiration provided the stock is below 192.5. That's where I want it to go, and that's where I want it to stay all the way to expiration. So $522, the max profit, what I can keep. Max loss, $478. Remember, this is a 10-point wide spread, so the calculation for max loss is going to be width of the spread, 10, minus the credit, 522, gives me 478. Okay, so that would happen at expiration if the stock was over the 202.5. And my break-even point is 197.72. So I've got that set up in there as well to be thinking about. Anything between there is no man's land. And then I can move forward here. I can edit the ticket. I can preview the ticket and place the trade or adjust it, whatever I want to do in that case. Okay, so I've got this thing set up. Let's go to the preview. I am ready to send this thing, and you can see exactly what it would cost me to go ahead and set the trade up, how it would affect my buying power. This is in my demo account here. All right, let's move forward here. Now, fortunately, if you did go ahead and pull up what Facebook has been doing, I took this screenshot March 4th. So 1 week later, and Facebook has really been getting pounded on as has really the entire market. So Facebook has certainly participated in the downside moves of the market recently, although I should say downside, upside, we've just seen a ton of volatility here. Okay, so Facebook bear call vertical spread 1 week later. Let's walk through the numbers here. So the green line right there versus that red line right there. The green line right there was my target. That's what I was hoping that the stock was going to get below. And when I took this screenshot, it was 189.34. So you may be thinking, wow, this thing is probably at maximum profit. Well, it's not, because the expiration on this, remember, is going to be March 6th, and I took the screenshot March 4th. So therefore, I know that I am not at expiration and I'm not at maximum profit, even though I am below my short leg. It's working out well, but it's not done. So let's go ahead and walk through this real quick. What if I decided that I wanted to close it out? So I took this screenshot just so that you could take a look at how the profitability or lack thereof of this trade. Fortunately, this one did work out, so it's an example of profitability, at least in this case. So the bear call spread closing order would simply be a reversal of the opening order. I would buy the lower strike back. That would be the 192.5. And I would sell that higher strike for whatever it was worth. So let me walk you through this. I would be buying back the 192.5. Now, I'd be buying it back, 95 to $1, and then I would be selling the other one. Look, the other one almost has no value at all. That's to be expected. Again, this worked out in my favor here. In order to do it, I set it up as a limit debit. Hey, I've got to pay back some of that money if I want to get out of this trade. Now, again, I just wanted to show you what the closing would be like here. There really wasn't a lot of evidence as of March 4th to close the trade out. It was working in my favor. I just wanted to get the screenshot because I'm filming this on March the 5th, so the trade hasn't closed out yet. But you could follow along if you want to go back and take a look how it ultimately closes out, which I don't know because there's still another day left to trade on this one. But to close it out, we would give back $94. So let me go back real quick. We'd give back $94. Remember what we brought in here. We brought in $522. The trade is working out for us from a price perspective. Now we just need it to work out for a time perspective. If we're not willing to hold it through the volatility that's going on, and we just want to close it out, great, we can close it out now for $94. So we brought in $522. We're going to close it out for about $94. That still means we walk with something like 80% of our maximum profit on that trade. Okay. Hopefully that gives you a pretty good overview of what we're looking for when we're doing bear calls and bull put credit spreads. Now, there's a lot of other things that are available out there as well regarding this topic. Definitely go to etrade.com/events or etrade.com/education, where you can find our entire video offering on this. So a couple of takeaways, and then we'll go ahead and wrap this one up. Because we're doing spread orders, you need to take a look if you want to do spread orders, and you need to be sure that the accounts that you want to do spreads have already been approved for options at a level 3. If you're at a level 2, you'll simply need to do an options upgrade. If you don't have any options approval and you go through the process, you'll want to mention that you want to do spreads. And then another thing too, you can mock up a vertical credit spread and observe the price action, and it doesn't have to be real money. If you're at etrade.com and you go to the complete view page, on the right-hand side, you're going to find that we've got the Power eTrade platform. You're also going to find that we've got basically a simulator there called paper trading. In that paper trading account, you can set up a couple of vertical credit spreads. You've got $100,000 there of fake money. Set up a couple of these things and just watch what happens with the price action. Watch what happens if you hit maximum loss or maximum gain. Sort of understand how to enter the orders, how to close them out. Kind of get familiar with all the things that we went through. And with that, folks, I hope that this has been a beneficial instruction for you. Thanks again for joining, and hope to see you in the future.